Let me switch focus. Nitesh Mittersain, who is the Joint Managing Director and CEO at Nazara Tech, joining us on the back of the acquisition that they've made, 990 odd crore. Nitesh, great having you. Good morning. Give us a sense, logic, rationale behind this acquisition. It's a large one for you.
Yes. Both the sister companies, Bluetile and Westplay, have a large user base in casual gaming. They have 17 live games, 22 million monthly active users. They've had almost 400 million downloads over the last few years for their games. About 10 million people installing it every month, and fairly scaled in terms of revenues. If you look at their 2025 revenues, it's about 1,400 crores in revenues with about 250 odd crores in EBITDA and generating strong cash flows. More importantly, the team, the founder being ex-Google and the rest of the team coming from, global gaming companies are highly competent and very focused on driving AI, or I would say AI-driven game development, which is helping them, deliver games at a much faster rate. And as Nazara can also benefit a lot from this technology and know-how. They also have a very interesting platform called Bestplay that allows for better user acquisition, content discovery, and monetization. So I think we see a lot of synergies with this opportunity. The company is almost similar to our size in terms of revenues and profitability. And we are very excited about this opportunity going into next year.
Is that the strategy going to be? Acquisitions abroad? Is that the next growth trajectory, you think?
As you know, over the years, we have been very active in M&A. And especially in the last 24 months, you would have seen us do multiple acquisitions in the Western markets, including two in the UK, one in the US. So we've and those were smaller acquisitions in the, companies having revenues in the 200 crore odd range. So we were also kind of honing our skills and building our confidence in being able to acquire global studios, integrate them with our platform, and grow them successfully and profitably, and also work with these global teams. So I think in the last 2, 3 years, we built a lot more confidence to be able to take larger steps like this one. This one, in terms of revenues, is probably 7 times the last two acquisitions we did internationally. And yes, I think it will take us some time to integrate this well, but it does open up and is a stepping stone for Nazara to be able to take much larger opportunities globally and really become a global gaming giant out of India.
How do you look at this entire scale up? Because you've been active from an inorganic point of view, and even this stake is around 50 odd %, which you are taking. Is there a agreement to increase your stake in this company going forward, and and fully buy out at some point in time?
Yes, we expect to make this into 100% by, I would say, 2028 at the latest.
And, how much of cash are you generating now from operations? Do you need to take some debt, or is it fully funded through internal accruals and cash which you have?
Yeah, so the first close is $100 million payment, of which 60 million has to be paid on the first close, and the balance 40 million 6 months after the first close. So we have sufficient capital at this point of time to fund, the first close. For the remaining, there will be multiple sources of funding, which includes the cash generated by Nazara's existing businesses, the cash generated by these two companies that we are acquiring, maybe some additional fundraise that we may do through debt and equity.
What is the kind of growth that these companies have been seeing for the last few years, and how do you project it? Project the growth for these companies going into next 2 years?
Yeah, we don't have a specific guidance right now. It's a bit early, but I think the companies have grown at a very rapid rate in the last 3, 4 years. Obviously, the base and scale has increased now, but they will continue to hopefully grow, very well for us.
And do you plan to bring these platforms into India as well, and integrate with your Indian platforms as well in some way?
Yes, of course. India's, our home market, it is a very strategic market for us. And while in terms of monetization, it is still small, as you can see, this whole focus, even of our government on social games, is very high. And we would like to definitely bring these games, the relevant games, to the Indian users and the Indian market in due course.
But Nitish, tell me, from what I understand is that this is an earn-out structure that you're building these new acquisitions on. Given the volatility in the gaming sector, and who would know this better than you, what specific EBITDA targets must these Spanish firms hit for you to consider the full payouts?
Yeah. Again, we haven't put out the specific targets and they are a bit long dated because they're over, I would say, all the way till 2029, 28, 29, and yeah, all the way till 2029. So we have these, estimates that the managements of these companies have given us. But I would say they are pretty aggressive targets. And the good news is that the earnouts are directly linked to performance in terms of revenues and EBITDA and cash generated. So that kind of also significantly, it does two things actually. De-risks the whole transaction for us against the volatility that you mentioned, but also it allows us to fund most of the earnouts through the cash generated by the acquired companies. And we'll have to put less capital going forward into them ourselves.
Just to get an understanding, you said that it's $153 million of revenue which they have generated in CY25. Are they profitable? And if they are, over the last many years you've been doing an inorganic growth.
Yeah.
How is your profitability going to get, grow from here on?
So if you do the maths right, the target company that we are acquiring now did about 1,400 crores of revenue in 25 with 254 crores of EBITDA in 2025. Nazara did about, in the 9 months of this year, Nazara has done for about 1,431 crores of revenue with 177 crores of EBITDA. So if you kind of extrapolate our numbers for the whole year, uh, both the companies, Nazara's existing business and his acquired business are of similar size, which means that ideally going into next year, we should be looking at doubling our revenues and EBITDA just through the acquisition. On top of that, both the companies should grow organically, which will create additional, growth streams and growth numbers for us.
The other thing is the synergies with Best Play, right? Because you've got an engagement platform now with 2.2 million users. How is it that you plan to leverage that with your mainstay and flagship assets like a Kidopia or an Animal Jam?
I think one is Best Play on itself is a very exciting platform and has huge growth potential from where it is right now. So I think a lot of focus is going to be how do we take these 2 million users to 20 million users primarily in Best Play alone, and what can we do to achieve that? In addition to that, because it's a captive in-house discovery platform, surfacing our games through the entire group across, like I said, Kidopia or Animal Jam or Love Island or all the different IPs and games that we already have, they can really piggyback on top of the Best Play discovery to further boost the business. So I think multiple opportunities on offer with Best Play. And many people have attempted setting up this kind of a platform, but very few have been successful. I think now that we have kind of hit the sweet spot with it, how do we scale it is a big thing on our table.
Nitish, lastly, I mean, considering you still had a consolidated loss in the previous quarter that you reported, when is it that your acquire and scale strategy will sort of translate into bottom line profits?
Yeah, I think very important to understand the Nazara numbers. We are generating EBITDA and we are also generating a free cash flow. I think our PAT numbers get misrepresented. I would not say misrepresented, but it's important to understand that because we acquire a lot of companies, we get a lot of intangibles on our books, which we amortize, and they kind of eat into the reported PAT. So seeing us from a cash PAT perspective would probably be a much better lens, or seeing us from a cash generated per share would be a much better lens, at least for the time being.
But Nitesh, I know you are suggesting cash generated per share, but the market looks at a PE multiple. So you will also have to get profitable and have a profitable track, profit sustainability also coming in.
We have a profitability. If you go back, right, we have a profitability track record since 2007 every year. So I think we're already we understand that, and we're a profitable company. I think last quarter saw a specific write-off on the moonshine pokerbazi business, which really caused that PAT loss. Otherwise, if you go back since our IPO, which was in March of 21, I think there've been 22, 23 quarters where we've been PAT profitable every quarter, except for the last one.
Right. Nitesh, great to have you today on ET Now. Thank you so much for speaking with us.
Pleasure talking to you. Thank you.
Okay, let's take a very quick break with news that we haven't seen anything of a recovery whatsoever in the equity markets. We're still down about 2.5 points, 2.5% rather, in trade. And HDFC Bank is now down over 5% as we speak. But we'll wind it up right here in this edition of The Market and Closing Trade.